So my name is Jeremy Caza of the Carta Group. The Carta Group is a fee-based financial planning organization based out of Syracuse, New York, but we're all over the Northeast. Actually, we have quite a few clients across the country now, especially up and down the Eastern Seaboard. So you can see the links there. You can see my email. So if for whatever reason you have another question or anything kind of comes up and you're just curious on something, by all means, feel free to reach out to me directly there at the jcaza@cartagroup.com. You can see our website there, cartagroup.com, and then the link right below that is just the direct link on our website to my bio. So I wasn't going to spend much time in terms of talking about who I am and what I've done in terms of experience and everything, but if you're curious on that, you can always go out to our website and see the information there. So today we are talking about the Secure Act. So what is the Secure Act? Well, it's short for Setting Every Community Up for Retirement Act. Nice long title that the government put together. And this new legislation, it went into effect at the end of the year, so it kind of flew under the radar for a lot of people simply because it was end of the year during the holiday season. It was attached to a spending bill, so it was just one of those things that was just kind of put in, and a lot of people didn't really pay too much attention to it or were unaware that this legislation was passed at the end of the year. So the legislation, for the most part, a lot of the rules pertain to 401k plans and the administration of those plans, but there are also a number of those provisions that directly affect individuals. So the way that we've broken up today's seminar is just to go through and talk about the main provisions that are going to affect individuals, and then we will specifically talk about the 401k side of things. It is important to note that some of these provisions, they take effect immediately. So they actually went into effect on January 1st of this year, while others are actually going to be delayed, and some of them will be delayed out to a few years. So 2022 is a starting point for a number of these, mostly because when they put the new laws into place, there wasn't the infrastructure in terms of the ongoing 401k administration, or there wasn't clarification on the rules. So some of these things actually have to be delayed simply because there is no true regulation in place to really make sure that these are effective immediately. So we'll go through that as we touch on each of these provisions. As was mentioned earlier, the chat session or the chat screen is there. So if anybody has any questions as we move along, please just post your question. And as we get through each or a few slides, I do want to make sure that we stop and take some time to go through those questions, and I'd rather answer those as we move along as opposed to waiting to the very end to try to answer any of those questions. So again, if you have something, just throw it up on the chat board, and as we get moving along, as we get through some of these slides, we'll definitely stop periodically and answer any questions that may come up. So as I mentioned, we're going to start out first with the rules that are affecting mostly individuals, and the first one that we talk about is the required minimum distribution age. So for those of you that are unaware, any account that you have that's pre-tax retirement account, such as a 401k, traditional IRA, 403b, SEP IRA, simple IRA, any of those types of accounts, once you reach a certain age, you have to start taking money out of those accounts. So basically, you put money into those accounts, it grows tax deferred, and you also would receive a tax deduction for the contributions on those accounts, basically meaning that you put money in, you don't pay tax on it, it goes into those accounts, grows to whatever it grows to, you get to retirement, then you have to start taking the money out. Under the old rules, the age of 70 and a half, so once you got 6 months past your 70th birthday, you had to start taking money out of those accounts. Under the new rules, they just bumped it up by 18 months, and they said basically the year in which you turn 72, now you have to start taking money out of those retirement accounts. So all they did is really delay that by 18 months, as I mentioned. Now, if you're covered by an employer plan, such as a 401k or 403b, if you're still working past the age of 72, then you do not have to take money out of those accounts. But once you get to that age of 72, now you have to start taking money out. If you reach the age of 70 and a half before the end of this past year, then you're actually grandfathered into the old rules. So if you turn 70 and a half towards the end of last year, you have to start taking that required distribution out this year, even though you're not yet 72. So basically on January 1st, anyone who has not had 6 months past their 70th birthday, they're now pushed to the new rules. Anybody who had already turned 70 and a half, they're under the old rules. And that's how everything will be administered moving forward. One thing to note, because 401k plans are involved in this, or employer-sponsored plans, is that the administration of these in terms of how the distributions need to occur. So if you still have your money with a 401k, this is being implemented over the course of this year. So in many cases, the notices and all this stuff that usually goes out, there is some question as to whether or not all of that will be ready, depending on the platform that you're with. So there is still some questions around the communication on this, but the rules do take effect as of January 1st of this year. Additionally, so sticking with the RMDs, required minimum distributions on any account that is inherited, that is a retirement account, now has new required distribution rules. So the way that it used to work is if you inherited a 401k, IRA, Roth IRA even, the person who inherited that asset generally could stretch the required distribution amount over their lifetime. So the rules were that if you, let's say, for example, left an IRA or 401k to a child, even if they were an adult, they would have what's called a required minimum distribution, which is the amount of money every year that has to come out of that account. They could take out more if they wanted to, but by law, they had to take out a certain amount, which was based on the account balance and the age that they are that calendar year. Well, now, those were the old rules. The new rules state that if you inherit any of those accounts, you have to deplete the account or completely withdraw all the funds out of it within 10 years from the date of death. So again, this is one of those, if you inherited the account prior to January 1st of this year, the old rules apply. If you inherit the account after January 1st, then the new rules apply. So again, that 10-year rule, the way that it works is the account has to be depleted. If it was an IRA or 401k, someone inherits that, that's a non-spouse, then they do have to take the money out within the 10 years. It's not that you have to set it up so, every year you take the same amount. You can do that if you wanted to. If you wanted to wait until the 11th month of the 10th year and let it just try to build up as much as possible, you could do it that way. You can deplete it well before the 10 years, but basically they just give you the 10-year time frame to make sure that all that money is taken out of the IRA, simply because government needed some additional tax revenue. And with all the pre-tax money in 401ks and traditional IRAs, this was a way to generate some additional revenue through the inheritance of those accounts. Now, there are some exceptions to this. As you can see on the screen there, the middle bullet point. So the way that this works, again, if it's a non-spouse, that's where the 10-year rule comes into play. If you leave an account to a spouse, so the spouse inherits it, then they could take those accounts over as if they were their own, and the 10-year depletion rule does not apply. If a child inherits this, so they're under the age of 18, then the way that the rules work is that once they turn 18, then the 10-year clock starts. So basically they have until the age of 28 to deplete the entire account. But if they're under the age of 18, everything is kind of held in the account. And then after the 10 year, or once they turn 18, then the 10 years kick in. Additionally, if the beneficiary is disabled, chronically ill, or any of those types of things, then there are some carve-outs to make sure that those assets don't have to be distributed out for those individuals. So they did give some thought to who would be inheriting these assets. But again, the prevailing thought on this was that they needed some additional tax revenue, and this was the best way to get it, was to force these assets out as opposed to letting people stretch the required distribution over their lifetime. One of the unintended consequences of this rule change has mostly to do with the estate planning side of things. So many people, they have what's called testamentary trust provisions in their wills, and most people don't know what testamentary trust is, but they have these trusts anyway already outlined in their wills, and that's where in your wills you have some type of trust language so that either a spouse, or usually it's for your kids, especially when your kids are young, that these trusts will hold the assets until your kids reach a certain age. So those are referred to as testamentary trusts. Again, one of the unintended consequences on this was that because of the way that a lot of the language is written into most people's wills, they don't have the proper language in there to satisfy the requirements on these new RMD rules. So specifically, if your testamentary trust allows for the stretch option, or even has it written in where the IRA or 401k will be stretched over the lifetime of the child, then the new RMD rules wouldn't actually be applicable here because of the way that that trust is written, and the RMD rules are actually going to supersede what's in the trust, or in terms of the language for the trust. So you'd actually have to update your estate documents to make sure that the language conforms with the new RMD law. So that's one of those things where if you do have wills and you have testamentary trust provisions, especially for young children, you're going to want to make sure that you revisit the language in those and make sure that it does conform to the new law. Additionally, there's a new IRA contribution rule. So the way that it used to work is once you got to the age of 70, you could still contribute to a 401k if you're still employed, and you would not have to take an RMD, so you can still continue on with that for 401k plans, 403b plans. So again, you can still make those contributions, but if you weren't employed or didn't have coverage of an employer-sponsored plan such as a 401k, but you were still making contributions to a pre-tax IRA or a traditional IRA, once you hit the age of 70, you were no longer allowed to do that. Well, under the current law, or the new law rather, they've amended that. So now if you are working past the age of 70, if you would like to, you can still make contributions to pre-tax IRAs or the traditional IRA. So that is something that you would still be able to continue on past the age of 70 now. One of the things that we always want to make sure we remind people is that if you want to make any kind of IRA contribution, you do need to have earned income. So Social Security, pension, or investment revenue, or income, or even rental income, any of those types of things, those are not considered earned income, so they do not qualify for having the earned income standard to make an IRA contribution. But if you do have earned income, and again, you want to make a traditional IRA contribution past the age of 70, now you're able to do so. One thing that was updated in the tax law a few years ago was where if you didn't need the money for the required minimum distributions, which again, it used to be at age 70 and a half and is now updated to age 72. If you didn't need that money or didn't want it for whatever reason, if you wanted to, you can make a donation of that required minimum distribution amount directly to a charity, and then you would not have to pay the tax on that withdrawal. And since it's going to a charity, this charity, they would not have to pay any tax on that gift that they receive. So there's no tax actually owed at all on the required minimum distribution. Now, they did change the rule in terms of when you have to start that from 70 and a half to 72, but they did not amend this part of the rule, which means that once you reach 70 and a half, if you want to take a withdrawal from a pre-tax account and have it sent directly to a charitable organization, you can still do so, and you do not have to pay any of the tax on that withdrawal. However, that money has to go directly to the charity. You can't have the money come directly to you and then turn and try to write a check to the charity. You have to make sure this is set up appropriately to make sure there's no confusion when you file your income taxes. But this is something that is still in effect, and you can see some of the additional provisions on that. The cap on the amount that you could take out of an IRA or 401k is going to be $100,000 per year for the donation. In many cases, that's well above the RMD, but you could take out additional monies above the required distribution and make a donation directly to a charitable organization if you so choose. And in addition, if you are taking money, or if you're still making a contribution to your pre-tax IRA, so again, if you're working past the age of 70 and you want to make a contribution to the IRA to get that tax deduction, they're not going to let you double dip if you're also doing the charitable donation to or from the RMD. So what they will do is, if you were to put a charitable donation from the required distribution, they will deduct out the amount that you actually put into the IRA as the form of a contribution to kind of even things out. So if you took a required distribution of say $20,000, but you're trying to put $5,000 into the pre-tax IRA, they're going to subtract the $5,000 from the $20,000, so you'd only get the credit of $15,000 in terms of how much you don't have to pay tax on from your required distribution that's being gifted directly to the charitable organization. The next rule change is one that unfortunately has not yet been approved by New York State. And it's in regards to 529 college savings plans. Now, 529 college savings plans are state specific in terms of their tax rules. When you make contributions to those, you don't get a federal income tax deduction. But in many cases, depending on the state in which you live, you can qualify for a state income tax deduction. So for the New York 529 plan, if you make any contributions, you can get a New York state tax deduction up to certain thresholds. So it's $5,000 per tax filer. If you're married, filing joint, that means that you can put up to $10,000 into a 529 plan and receive that deduction. You could put money, more contributions in above the $10,000 threshold, but they cap the $10,000 threshold in terms, or $10,000 contribution amount in terms of getting a deduction. The way that this rule was amended, which other states would have to adopt as well, but they would allow up to $10,000 to be deducted from 529 college accounts and use those assets to repay student loans. So in many cases, what would end up happening is if you have a 529 plan and maybe the student has taken out some loans, or maybe they get some gifts or scholarships or whatever it may be, once they graduate college, there might be a little bit of money left in the 529. Well, under the old law, if you took that money out and there was gains on that money, you're gonna have to pay taxes, and there's a potential that you'd have to do some type of recapture on the tax deduction you took for that money. Now, under the new rule, as soon as the states adopt it, you could take out up to $10,000 per student over the course of their lifetime to repay any kind of student loan debt. So that would be pretty impactful in New York. So if there's money left in 529s, you have some student loans. If New York State adopts that, then you could potentially pay down those student loans from the money that was left in the 529 plan. Additionally, under the federal rule, they do want to allow certain apprenticeship programs and things like that to now be utilized from the 529 savings plans. Again, in New York, they have not adopted these rules as of yet. But that's something that we are monitoring, and hopefully they will adopt these rules sometime in the near future. Another new rule as it pertains to withdrawals from accounts is that you can now withdraw up to $5,000 from a 401k or IRA account, so a pre-tax account, to cover the birth of a new child or for adoption fees of a child. So for people who are starting out with a family, if they wanted to take monies out of a 401k plan, usually the way that they could only do that previously was through a loan or some type of hardship withdrawal. Now they would be able to qualify for this new withdrawal rule up to $5,000 from the 401k or the IRA to offset any expenses specifically for the birth or the adoption of a child. Now, if you did take this withdrawal out and then changed your mind and wanted to put the money back in, you do have 60 days to be able to put the money back in, and they'll treat it like the 60-day rollover rule. So right now you can still take money out of an IRA, pre-tax IRA. If you put it back within 60 days, then you don't have to pay the tax out or possibly early withdrawal penalty on that withdrawal. But you can only do that once per year. So under this, if you did take the withdrawal for the birth or the adoption of a child, change your mind, you want to put the money back, you can still do that within the 60-day time frame. So this did go into effect, as you can see, at the end of this past year, so effective January 1st. However, because this is a new rule, and especially as it relates to 401k plans, 401k plans are all managed by their plan document, and what we find is that a lot of record keepers just haven't been able to make the adjustments yet to amend the plan documents to allow for these provisions. So that's something where, again, the law is kind of ahead of the actual implementation process, where in many cases they may not be able to catch up to the law for a certain period of time, just simply because of the amount of time and potential expense it would be to go through and update all the provisions in all these plan documents. So that's something where, although this is an allowable rule, it may not actually be covered depending on the type of document the 401k plan is using. So we're going to switch gears a little bit and talk more about what the provisions are that are primarily related to the 401k plans. And the first one that's a big change, especially as it relates to employers that use a lot of part-time workers, is going to be the eligibility factor. So in many cases, employers are able to limit the participation in the 401k plan by requiring that employees work 1,000 hours per year. So if you do the math on that, 1,000 hours per year is basically averaging 40 hours per week of work over the span of 50 weeks, 2 weeks left out for potentially vacations. But if you require the 1,000 hours, then that's usually the criteria to be able to participate in the 401k plan. So that was the old rules. Now, under the new rule, that threshold can be dropped to 500 hours. So if you have employees that work 500 hours, which is the equivalent of roughly 20 hours per week over the course of the year, they now have to be made eligible to participate in the 401k plan. Now, there are a couple things that do not apply for these workers, which is employer contributions are not required for this group. So if you're doing any kind of employer matching, you do not have to include these part-time workers into that matching calculation or contribution calculation. Additionally, these employees can be excluded from testing and testing safe harbors. So any of the testing that's done at the end of the year for your 401k plan in terms of contributions, top-heavy test, and all that type of stuff, these employees can be excluded. So the real purpose of all this was really because they wanted to make retirement savings more accessible to more workers. So the whole idea again is that if you have employees who are between that 500 and 1,000 hours worked per year, they wanted to give them access to a 401k plan without putting too much burden back on the employer by having to require them to make any kind of employer matching contributions. So these employees could just, at the very least, they're able to put the money into the 401k plan from their own paychecks. Now you can see on there, this does not become effective until the end of this year. And the hours that would be included on this is only going to be, or can be effective starting on January 1st of 2021, looking backwards. So the 500-hour threshold applies for 3 consecutive years. I don't think I explained that properly to start this slide. But basically, if you look back over the last 3 years, they would have to have averaged 500 hours or more for the 3 years to be eligible for the 401k participation. So again, this goes into effect at the end of this year, but then they're going to look backwards, and you can basically use the 3 years leading up to that point to be able to determine if these employees can be eligible to participate in the 401k plan. Auto enrollment, safe harbor, which is referred to as a QACA. You can see that there, the QACA. The way that auto enrollment usually works is if you have a 401k plan and you want to automatically enroll your employees into the plan, you can still do that. And usually a lot of employers, when they do that, they will put in an escalation clause in there, meaning that if they automatically enroll all employees at, say, 2% of their gross salary, they may put an escalation of 1% per year, so that way the employees continue to increase their contributions into the 401k plan. And under the old rules, they could put that escalation clause in, but they had to cap it at 10%, meaning if you started at 2%, you can escalate it all the way up until they hit 10% of the gross salary, unless the employee actually made an adjustment on their own. Now that auto escalation cap has been increased to 15% of their gross pay, and that does take effect immediately. However, again, This is one of those things where they allow this to occur, but the regulations and the actual implementation of the law is going to lag behind when the law actually goes into effect. So in many cases, although the cap can be raised to 15%, it's not going to actually be able to be implemented right away until adjustments to plan documents and things like that have been completed. Another rule that's been changed is that you need to now include the annuity option and how much that annuity option would actually pertain to on 401k account statements. And that has to be provided at least annually. Now this does not take effect until 2021, but the way that this is really meant to look at is the annuity option is usually listed in pretty much all 401k plans. And the idea behind this is that the 401k platform has an affiliation with an insurance company, whereas if the individual or the participant wants to take their money and create a monthly income stream, so almost like a pension, they can take their 401k balance and they move it into this annuity, and then in return they get a guaranteed monthly income stream that they cannot outlive. And usually with those options, you're going to have typical pension options such as a life only for the participant or a joint type option where it covers the participant and the spouse, things like that. But in most cases, most people aren't even aware that that's an option. And what the intention of this rule change is that they want people to understand that they can take their 401ks and turn that into retirement lifetime income. So what they want to have included on the statements is just information pertaining to that, so that way people are aware of all the options that are available upon retirement and what they can do with their 401k balances. Additionally, lifetime income options are going to be starting to come into the 401k plans, and they're going to start being offered most likely, I would say more intensely is probably a way to describe that. So basically the way that this would work is right now, some 401k plans offer an annuity type benefit on your 401k account. So if you're an employee and you want to have some of the guarantees associated with annuities, which many annuities do offer in terms of high watermark lock-ins or things like that, 401k plans usually don't offer these, and the primary reason for not offering these is because if the employer has the plan with, let's say they have a Fidelity plan and then they decide to take that Fidelity plan and move it over to, say, Vanguard, if you did have any of those types of annuity features on the old Fidelity plan, then the employee loses those benefits once the plan is moved to another platform. And all the fees that have been associated with having those guarantees are now lost from that for the employee. So what they're looking to do is, in terms of what this law is they want to start offering new annuity features into the 401k plans to have those guaranteed sources of income again, kind of like what we talked about on the previous screen in terms of having that show up on your statement. But now the idea is to offer more annuity features inside of the 401k plans themselves, but then also offer the employees who do elect those features a way to continue those features on if the employer decides to move the plan to another platform. So this is one that takes effect immediately. However, we talk to a lot of industry analysts, insurance companies, advisors, all that type of stuff, and most people have no real idea how this is really going to be implemented. So this is one of those where I think the law has been passed predominantly to give access to this type of idea, but right now this idea is probably still something that has to really be thought through and tried to figure out in terms of how it can truly be implemented to benefit employees, make sure that employers are protected, and make sure that these annuity features are actually administered properly. One thing I did forget to mention, the first bullet point there does talk about in terms of the fiduciary safe harbor on the selection of the annuity. So what that refers to is right now, or not right now, but previously, if the employer did elect to offer one of these annuity options inside of the 401k plan, they had a fiduciary responsibility to make sure that that offering and the insurance company that they did select was going to be able to provide all the services and everything else. So they had a fiduciary responsibility on that. Now, under the new rules, that's relaxed in terms of the fiduciary liability on the employer. And what they really look at is that now they can trust what the insurance company or annuity provider is doing in terms of satisfying certain conditions. So what it does is it kind of reduces the liability on the employer side, so that way they can start offering these additional services right inside the 401k plans. Additional changes include safe harbor. So under the previous law, you had to adopt safe harbor provisions right up at least 30 days prior to the end of the year. The reason for that is because if you adopt safe harbor provisions, which if you didn't have those already on the 401k plan, you have to allow so much notification to the employees prior to adopting those new safe harbor rules. So safe harbor is usually a common plan design that many employers will put in, where it has mandatory matching requirements. There's two formulas for that. One is a discretionary or non-discretionary rather. So it's a non-discretionary match of 3% of the gross pay for each employee. So whether or not those employees actually participate in the 401k plan or not, the employer under that model is required to put 3% of their gross pay in for the employer contribution, employer match. Or not match, but actually just the contribution. What that does is then it usually relaxes some of the year-end testing requirements, which sometimes if you have an employer where the owner of the business or the executive team is maxing out all their contributions, but many of their employees are not putting very much away in the 401k plan. By switching to these safe harbor rules, usually you can then avoid some of the testing issues that come into the plan at the end of the year. The other matching formula is 100% on the first 3% of contributions and 50% of the next 2% of contributions that an employee makes. But that's discretionary, meaning that if the employee does not participate, then the employer does not have to match that. So that's usually the most common safe harbor matching formula that we run into. This new change here is specific to the non-elected contribution side. And what they talk about here is that instead of making the change 30 days prior to the end of the year, that rule still applies. But if you want to make the change for the current calendar year, you can make it during that calendar year, but you have to increase your non-elected contribution matching percentage by an additional 1%. So they're basically saying, yeah, you can change over to the safe harbor. You're just going to have to increase how much you're going to give the employees if you don't do it in the normal 30-day prior to the end of the year time frame. Again, this is one that's implemented or at least available right now, but there's a lot of questions regarding these new rules. Most likely you're going to see additional regulations or clarification from the IRS and Department of Labor on how these new rules should be implemented. 401k startup credits. So this is something that often is overlooked by many employers, but under the previous law, if you had under 100 employees, you could receive a tax credit of up to 50% of the annual administrative costs with a maximum credit of $500. So a typical startup plan usually costs anywhere from a few thousand to $5,000 to get up and running, because usually you have to pay for the annual plan administration, as well as the plan document fee, and there may be some additional fees depending on the plan design. So the credit that you could get under those scenarios is capped at the $500. Under the new rule, the 50% of the annual admin cost is still applicable, but they've increased the maximum credit to now $5,000. So the idea behind that is they want to incentivize smaller employers to start offering 401k plans. And by giving this type of credit, it eases the burden of having that out-of-pocket expense up front to get a plan up and running. Additional rules that were implemented. The one that made the most headlines in the 401k world is as it relates to multiple employer plans. So a multiple employer plan is where lots of other employers, they all pool together for economies of scale, and they utilize one specific 401k plan. So usually it's they have a common plan document, they use the same investment platform, same investment lineup, and they have a lot of the same similar features for the 401k plan. They do, or they are allowed to have their own plan design, so you can have safe harbor, non-safe harbor, you can have your own vesting, own matching criteria, eligibility, all that type of stuff. But that's what multiple employer plans are, is it's usually a group of employers pooling together to have the similar plan design. And because everyone's coming together with those economies of scales, it usually reduces the overall out-of-pocket expenses for the employer as well as the employees, simply because there's more assets collectively to help reduce the overall fee structure for everybody. So that's an MEP, and some of the rules on this were actually enhanced or relaxed, and the Cayuga County Chamber of Commerce already offers multiple employer plan benefit for its existing members. So some of the provisions that were adjusted under the MEPs, you can see the 50% tax credit on annual plan admin costs. So if you were looking to go into what's called a true MEP, which means that there's only one 5,500 annual filing for the entire MEP, so all the employers that go into it, there's just one 5,500 filing, which is basically the year-end tax filing for the 401k plan. If you have one filing for the entire group of plans, that is a true MEP. The Cayuga Chamber plan works a little bit differently in the sense that every employer has their own 5,500. However, that is all done for every employer because there's a 316 fiduciary services provided directly into the plan. So all the admin is actually outsourced and taken care of by a third-party vendor that the chamber has utilized. Under these other MEPs, which begins in 2022, you can have that 50% tax credit for admin costs by joining one of those MEPs. With the chamber MEP, you do not have to wait till 2022. It's actually in effect right now. So I think on the next slide or the slide after that, we go through some of the expenses associated with the chamber plan. But basically, if you did adopt into the chamber plan, you could offset 50% of that cost simply because of this tax credit. One of the other provisions was what's called the one bad apple rule. And what that means is when you have a multiple employer plan, if one employer is constantly out of bounds in terms of their plan administration, technically it could have ruined the entire MEP for all adopting employers. Under the new law, they got rid of that. So if you had 50 employers pulling together in one of these MEP plans and one of the adopting employers is a bad actor and they're not doing what they're supposed to be doing from an administration perspective, then that one bad plan cannot ruin everything for everybody else. And that plan could just be removed directly from the MEP. So it has drastically reduced liability for employers that do want to participate in these plans. Additionally, employers with 100 or less employees get a $500 per year credit for 3 years by adding automatic enrollment for employees. So this would apply for the Cayuga Chamber MEP, simply because, again, it's the way that the Chamber's MEP is designed with the individual 5,500s and all those types of things. So any adopting employer that is under 100 employees that wants to add automatic enrollment, they can now qualify for a $500 credit that is good for 3 years moving forward. So this slide talks a little bit more about the Cayuga Chamber MEP. Again, the rules have been relaxed quite a bit as it relates to these multiple employer plans. But what we're finding is that because the rules were delayed out till 2022, that it is going to take a couple of years for a lot of these other plans to really get up and running, while the Cayuga Chamber already has one in existence, and it's been around since, I believe, 2013 was the initial date that went into effect. So here are some of the provisions regarding the multiple employer plan benefit that is already offered through the chamber. Again, as I mentioned, it allows employers to outsource their 401k plan to the Cayuga Chamber, which includes outsourcing the investment oversight and the ongoing annual plan administration. As an adopting employer, your only responsibility is to make sure that your payroll files are submitted in a timely fashion and that you provide your year-end census or verification of the census at the end of every year. Other than that, everything else is outsourced and taken care of for you. Adopting employers are allowed to design their 401k plans based on their needs. So you can have unique plan design opportunities. You can have no matching. You can have safe harbor matching, all those different types of things. You can have your own vesting schedules, eligibility. So you can design the plan specific to the needs of your organization. But what you do have to do is you have to utilize the chamber plan document, the investment platform, which is Transamerica, and you also have to utilize the third-party administrator, which is Pinnacle Financial. Pinnacle Financial based out of Fort Lauderdale, Florida. So I know there's a lot of Pinnacles, especially in upstate New York. There is no affiliation there in terms of the companies being the same. So Pinnacle based out of Florida is the third-party administrator. So you do have to utilize the companies that are already put in place to provide the 401k investment platform as well as the ongoing administration. Investment management services are provided to all employees in the 401k plan at no additional expense as well. So there is a do-it-for-you solution that will actually pick and choose from the various funds in the lineup and customize an allocation for each participant, and it will be managed to their retirement. One thing that's not on here that I should also mention, though, is these plans are really set up mostly with the emphasis on smaller employers, but they're also incredibly beneficial for larger employers. So for the Cayuga County Chamber's 401k benefit, any employer that is over the 100 total eligible employees, and they do have the plan audit. So for those of you that aren't aware, the annual plan audits for 401k plans can range usually from 8,000 to 12,000 on the low end, all the way up into 20,000, 25,000 I've seen them charge. The way that the chamber benefit works is that because the plan document and all the other things are so similar, we've actually engaged an accounting firm who is also based out of Florida that will provide these annual plan audits at $3,000. So they will cap the expense at $3,000, which we found is usually a pretty significant savings over local plan auditors, usually anywhere from $5,000 to as much as $10,000 is the annual savings that we see. The out-of-pocket cost for any adopting employer for the Cayuga Chamber 401k benefit is $850 per year. They do need to be a chamber member. If not a chamber member, then they need to be added in, or they have to join the chamber to have access to this 401k benefit. But the $850 per year is the only cost that the employer would incur for annual admin charges. Most administrators charge at least twice that. In many cases, it's 2 or 3 times, or it's 3 to 4 times that rather. So that's usually a pretty significant savings. And this also applies to any startup plans. So if it's a brand new 401k plan, your out-of-pocket cost as an employer is only $850, whereas most companies are going to charge you the annual plan admin fee as well as a plan document fee. Included in the $850 is a $100 credit towards the fidelity bond. So a fidelity bond is a bond that is required by law to be on a 401k plan. And what it does is it's supposed to insure against theft of any of the 401k assets, usually by the employer or somebody at the employer who has access or responsibility for submitting contributions. So typically that fidelity bond has to cover at least 10% of assets, and the Cayuga Chamber will secure the bond on behalf of the employer, and as long as the bond is under $100 in terms of the cost, then the chamber will cover that fee for the adopting employer. If it goes over $100, then whatever the difference is going to be billed directly to the employer. So if it came to, say, $140, the employer would only be billed for $40 to secure that bond. So that concludes today's webinar. On the chat screen, unless it's not working properly, I didn't see any questions pop up, so that's why we didn't stop for questions. But I'll stick on for a few more minutes. If anyone has a question, by all means, you can post it in the chat session. You can email me separately. So I'll put that back up in terms of my contact information. So that is my email. By all means, if you'd like to reach out, you have any specific questions that you'd like to go over, you can email me separately, or you can reach me. My direct office number is 315-445-3177, and I'd be happy to answer any questions.